The major averages finishing the day lower, with the Nasdaq getting hit the hardest, down 2%, dragged down by chip stocks, including ARM, Marvell, NVIDIA. Let's bring in JPMorgan Asset Management Chief Global Strategist David Kelly. David, good to see you. So on top of that, how do you see the U.S. fiscal situation affecting this market going forward?
Well, I think it's going to have a very interesting impact, because I think what we're going to see here is a zig and a zag. Right now, there's a lot of cuts going on. We've got the Doge cuts. We could perhaps lose 300,000 federal workers this year, so maybe a 10% reduction in the overall federal workforce. And that's, admittedly, the federal government needs to get more efficient, but that does impart a certain drag on the economy. So you've got a drag from that, you've got a drag from tariffs. But the more this drag materializes, the slower the economy gets, the more stimulus are going to pump into that tax bill that is winding its way through Congress right now. And so I think that 2026 will be a year of significant fiscal stimulus, and we're going to go from a year where the economy was really growing below trend to one when it's growing above trend in 2026. And for markets, that's a pretty complicated thing to try and figure out. But I do think the debt and deficits are going higher here.
What about the entitlements piece of this? I keep trying to figure out whether the Doge cuts are really effective versus what the entitlements weigh on these big areas of spending for the government.
No, I think it's all a matter of scale. The truth is the deficit this year is going to come in at about $2 trillion. The Congressional Budget Office is saying 1.9. I think it's going to be closer to 2. If you got rid of every single civilian member of the federal government, you'd save about $300 billion. So you'd save about a sixth of the deficit if you just get rid of all the federal employees. You can't actually balance the budget without cutting Social Security, cutting Medicare, cutting defense, and raising taxes. You can't get close to deficit reduction. So I think while there is waste and inefficiency in the federal government, it's a good thing to get rid of it. I think you've got to be careful how you do it. Make sure that you're genuinely getting rid of things that can be got rid of. But it doesn't really affect the big long-term deficit story. That requires hard decisions on taxes and entitlements, and I don't think we're going to see either of those ahead of elections, and we're always within 2 years of a congressional election.
If you were to actually see some of those hard decisions materialize, say that actually happened, is that the type of thing that could lead us into a recession? I just think about previous times in history when we've had to go back and balance the budget.
It doesn't have to, because hard decisions, it's like in life. I mean, if you've got to go on a diet because you're 50 pounds overweight, don't try and get rid of it in a week. You give yourself a year, 18 months to do it. Do it slowly. The economy is very like that. If you had a long-term, slow process by which you would gradually raise more revenue, gradually chip away at different parts of entitlements, and try to make it a more efficient system, try to make the healthcare provision in this country more efficient, because it's horribly inefficient. If you do it slowly over time, you can get, and you don't even need to get a balanced budget. If you get to a deficit of 4% of GDP, that'll stop the debt to GDP ratio from rising. We're at about 6% right now. The problem is I think we're more likely to go from 6 to 7 rather than 6 to 4. So no, you don't have to have a recession, and you don't have to fix it overnight, but you do have to head in the right direction.
And to your point, the interest payments alone that come due here over the next couple of years. I do want to go back to what you said earlier, and that was the fact that you expect this drag on the economy, and then through tax cuts and other means that maybe we see this fiscal stimulus begin to emerge in the second half of this year. What does that mean for investing? How do you navigate this right now? What would you be buying, or how would you be positioning?
Well, I think, first of all, I don't expect the actual stimulus to kick in until 2026. I think they'll try and warm up the economy ahead of the November 2026 elections, and it'll all be part of that tax bill. But I do think there'll be stimulus there. Investors should look forward to that and recognize that if we have a soft patch here, or even if we had a recession, it's probably going to be short-lived. But having said all that, we've got heightened uncertainty. We've already had a correction. That correction could sort of reassert itself, could get worse. And this is a year for thoughtful defense. I mean, if you look at what's happened so far this year, value has beaten growth, international has beaten the U.S. There's the things that have got hurt the most are the things that were most bubbly to start with. So I think this is a year when people really need to think carefully about valuations here. Don't get out of long-term assets. I think there are plenty of good long-term assets around the world and in the United States, but just be more broadly diversified. And this is not a year for momentum trade or just piling into the indices, piling into the mega caps and the meme stocks and the cryptos and so forth. This is not that kind of year.